Hello everyone, and thank you for joining us for another Databank podcast. My name is Gillian Hammer, Chief Marketing Officer at Databank. With me today is Courage Martey, the Senior Economic Analyst at Databank. We will be discussing inflation as well as the recent monetary policy update. Courage, welcome.
Thank you for having me, Gillian.
I hope you are well.
Very well, by God's grace.
Okay, very good. So we'll get right into it. My first question will focus on the recent report released by the Monetary Policy Committee. In the report, it stated that inflation for February dropped to 13.2% from 13.3% in January. In your view, what is causing this reduction, and do you think we'll witness further reductions in the March figures?
All right. The cause of the decline. You recall that in 2016 we had heightened inflationary pressure, mainly because of an increase in fuel prices, utility tariffs, transport fares. So all these factors increased the consumer price index. Now, when you move into 2017, 2016 becomes the base for calculating 2017 inflation data. And because of the higher base that we had from 2016, there is the base effect that is accounting for the decline in inflation that we are seeing, and we are likely to see further in the subsequent months in 2017. But there's also the situation where the central bank has all the while held a tight monetary stance, maintaining the policy rates in excess of 25%. There was a time when it was at 26% for 12 consecutive months, and then they slashed it slightly in November 2016 to 25.5. But then even that was quite tight. And so this tight monetary stance, together with the base effect that I mentioned earlier, contributed to the decline in inflation that we saw in February. And of course, that is just a continuation of the sustained decline we saw in the last 5 months to February 2017.
So we will likely see a further reduction in March.
We are quite likely to see a further reduction in March, but I must add that there are both upside and downside risks to inflation.
Okay.
So there are, for instance, the depreciation pressures we experienced in the early part of this year could still, spill over into further inflationary pressures, But I believe that the base effect is still active in the inflation dynamics. The monetary policy still maintains a tight stance despite the reduction that was done recently. It's still a tight position, and I think that these factors can also pull down the inflation. So broadly speaking, there's a huge possibility of a decline in March.
Okay. Now, before the press release came out from the Monetary Policy Committee, there was a summary of economic and financial data that was released. In that summary, it stated that the 91-day Treasury Bill rate dropped to 15.94% in February from 16.16% in January. What do you see as the cause for this decline in Treasury Bill rates, and do you expect it to continue as well?
All right, starting with the cause. As investors, when we buy Treasury Bills, what we are doing is, even though from our perspective we are investing, we are also lending money to the government, and so the government is borrowing. Now, from an investor perspective, you want to get as high an interest rate or a return as possible. But from the borrower's perspective, which is a government perspective, you want to also reduce the cost of the debt, which is the interest rate that you pay on the debt. And so from the government perspective, they've had to pay significantly high interest rates over the past couple of years because of the high inflation that we experienced and the high cedi depreciation. But that has also eaten up into the government's revenue, because we got to a point where, as we speak, the government uses about 1/3 of its total revenue to pay just interest on its debt.
Really?
That reduces the available revenue for other public sector spendings, and so the government is seeking to reduce how much it spends on interest payment. Okay. So they embarked on what they call the debt management strategy, which is to ensure that you use a longer term debt to pay off expensive short-term debts, because the short-term debts are the ones that mature frequently, and that was the 91-day, the 182-day, they mature every 3 to 6 months.
Yes.
And the government with limited finances will have to roll over at a higher interest rate. So what the government has done is to go and source for long-term loans,
okay,
and use that to pay off some of the short-term debts. and that has also led to a reduction in the interest rate for Treasury Bills. So that's one of the major causes of the reduction in Treasury Bills, and as well the fact that the inflation outlook is now quite improved.
Right.
Investors expect that inflation will decline further, and so they are willing to tolerate lower nominal interest rates,
okay.
And that has led to the decline that we saw in the T-bills rate.
Okay, now if we look at the monetary policy rate, we saw something that we have not seen in the last 10 years. We saw the rate come down from 25.5% to 23.5%. That's a very significant reduction. And what I would like to know from you is, what do you see as the factors that led to such a big decline?
All right, so the central bank, which is the Bank of Ghana, has two basic mandates. One is the primary mandate, which is to ensure and maintain price stability in the form of low, or if you like, single-digit inflation, and a relatively stable exchange rate. The secondary mandate or objective is to ensure economic growth and development. Now, the primary mandate tends to override every other mandate. So in a time where we have high inflation, the central bank tends to sacrifice growth, tighten the monetary regime, increase policy rate and interest rate to ensure that that high inflation is reduced to the low level they want it to be. So that had informed the policy rate increase to as high as 26% in recent times. Mm-hmm. Now, the increase has successfully contained or reduced inflation pressures. Okay. And as we are expecting inflation to come down further, the Bank of Ghana is also positive in that regard, that inflation will continue to decline. Having achieved that result on the end of price stability, then the central bank is saying that there is a need to lean towards the secondary mandate, which is supporting growth.
Okay.
Because you have to sacrifice growth to restore price stability. So then, since price stability is in the process of being restored, the central bank is gradually leaning towards growth now, supporting growth. So they decided to reduce the policy rate, ensure that banks are able to give out loans at lower rates, which can boost economic activity and growth in entirety.
So that actually leads me to the next question, because this was now, typically you see a connection between the monetary policy rate going down and the banks reducing their lending rates. But it doesn't always happen.
Yeah, sure.
And not necessarily immediately. So in this case, do you think that the banks will respond and lower their lending rates?
No, I agree with you, and I expect that it will not happen immediately. As we speak, the immediate impact we've seen is that there's been a knock-on effect on the interbank interest rates. So since the monetary policy rate was slashed to 23.5%, we've also seen the interbank interest rate dropping from 25.2% to, as at close of business yesterday, to 23.87%. So that's also a significant drop in line with the policy rate drop. Now, that drop in the interbank interest rate, all of that things being equal, is expected to reduce the banking industry's cost of funds, because that's the cost they incur when they borrow amongst themselves or lend among themselves. So
the interbank
lending
rate.
Exactly. So once that lending rate drops, the cost of funds for the banks is expected to drop, and it's expected that they will pass on that cost to businesses that comes for loan. When that happens, you think that it will result in a lower interest rate on loans, but that may not exactly happen immediately. Because as we speak, another concern is the high non-performing loans ratio, which is currently at 17.7%, quite high for the industry. Essentially, what that means is that every 100 cedi of loan that is given out, 17 cedis of that 100 cedis is at risk of not being paid back, or at risk of default.
But is there an improvement over last year, or is it 17.7?
Well, we closed last year at 17.3. So to have the latest numbers at 17.7 is a marginal increase. It again has to do with spillover effect of the difficult economic challenges or difficult economic environments that businesses had grappled with in the last few years. That has affected their loan repayment abilities, and that's impacting on the portfolio quality of commercial banks. And because of that, the commercial banks themselves are also not willing to aggressively give out loans again. They are also being cautious. So even if interest rate declines, if their asset quality is still poor, they will still not be that encouraged to give out so much loan. They want to ensure that they are guaranteed of repayment before they can aggressively give out more loans. So these are the risk factors to an increase in the loan book.
But wouldn't lower loan rates increase the chances of people paying back?
Well, lower loan rate, interest rates would mean that people have a high chance of paying back, because normally what you tend to say is that a lot of the businesses we have low profitability, especially the SMEs. Now, when they go for bank credits, they are faced with high cost of loans, which eats up a lot of their working capital. And so they sacrifice their working capital to pay the loan. They get to the point where the business is gone, but the loan is still outstanding. And so there is default. So when you charge low interest rate, it gives them the opportunity to be able to turn around and pay you back. But that will also depend on the bank's own cost of funds and operating expenses, efficiency with which they operate as well.
Okay. So as we get ready to wrap up, are there any other effects that a reduced monetary policy rate will have on the Ghanaian economy?
Well, when you reduce the policy rates, what you do is that you are signaling to the market and investors that the risk to the future or the outlook is lower now. And so people should be encouraged to take more risk or do a lot more business on the side of the economy. And then what you also see is that investors become very confident and can let go capital because they know that the risk to their capital has been signaled that it's low. So investment decisions are encouraged. What you also see is that interest rates generally in the economy tend to go down because it is anchored on the policy rate. If the policy rate goes down, all other interest rates, including interest rates on investment assets, are supposed to come down. Once that happens, the fixed income market and fixed income securities like Treasury Bills and other fixed deposits account and so on becomes less attractive. But the benefit is to equity market or stock markets, because then investors that want returns on their investment will start exploring options on the stock market. So whilst the fixed income market may not become attractive, the equity market becomes then attractive.
And we're already seeing a good recovery in the
Absolutely.
equity market.
We're also seeing good recovery on the equity market. So you see that some investors are already taking position in anticipation of these opportunities.
Absolutely. Courage, thank you very much for your time. Any final words that you'd like to share with our listeners? Well,
I'd like to end by assuring investors that the decline we are seeing in interest rates does not necessarily mean that you don't have opportunities to invest, because we always say that every challenge presents a new opportunity.
Absolutely.
So the challenge to your fixed income investment presents opportunities in the stock market. So I would advise investors to speak to our brokerage team, who would advise them on the right stock pick for an increased return on their investment in the stock market.
And they can even consider looking at equity mutual funds if they don't want to go directly into the market.
If they don't want to go directly into the market, they can also limit their risk by looking at our equity, mutual funds, especially EPAC.
Okay, thank you.
You're welcome.
Courage, thank you very much for your insights today. To our listeners, you can access the full report behind the information that Courage gave us by visiting the research page on our website at www.databankgroup.com. You can also send an email to research@databankgroup.com as well to get a copy of this report. Have a wonderful day, and you'll hear from us again soon.